Good day, everyone, and welcome to our mock meeting where we'll be comparing the liquidity of two logistic companies, Gdex and Post Malaysia, based on their current ratios. I am your host, and we have our financial analysis Adlina here to guide us through this analysis. Let's dive right into it. Adlina, could you please explain the significance of the current ratio and how it reflects a company's liquidity?
Sure. Hi, morning, everyone. Actually, the current ratio is a key of indicator of the company liquidity. Specifically, its ability to meet short-term financial obligation. It's calculated by dividing current asset by current liabilities. A ratio above 1.0 suggests that a company has more current asset than current liabilities, indicating good liquidity.
Thank you, Adlina. Now let's look at our examples, Gdex and Post Malaysia. Adlina, could you please walk us through the comparison?
Actually, Gdex has a current ratio of 4.89, which means they have 4.89 ringgit in current asset for every 1 ringgit in current liabilities. In contrast, Post Malaysia has a current ratio of 0.78, indicating they have only RM78 cents in current assets to cover 1 ringgit in current liabilities.
That's quite a difference. Adlina, what are the implications of these ratios?
Well, a current ratio above like 1.0, like GDAX 4.89, generally suggests that strong liquidity and the ability to comfortably meet short-term obligation. However, such as an exceptionally high ratio may also raise concern. It might indicate that the company is not using its asset efficiently and could potentially consider more productivity investment.
Interesting point. So, Adlina, what about post Malaysia's ratio?
Post Malaysia ratio of 0.78 is below 1.0, which could raise concern about their ability to cover short-term liabilities with their current assets. It might indicate they need to manage their liquidity more effectively.
Let's jump right into it. Intan, could you please explain the acid test ratio and why it's a crucial indicator for assessing a company's liquidity?
Sure, Ashraf. The asset test ratio, also known as the quick ratio, is a measure of a company's ability to meet its short-term financial obligation without relying on the sale of inventory. It's calculated by subtracting inventory from current assets and then dividing by current liabilities. A ratio above 1.0 suggests good liquidity.
Thank you, Intan. Now let's analyze our two companies, GDEX and Post Malaysia. Intan, could you provide some insights into their respective acid test ratios?
Gdex has an acid test ratio of 4.85, which means they have a 4.85 ringgit Malaysia in highly liquid assets for every 1 ringgit in current liabilities, without even needing to convert their inventory into cash. In contrast, Post Malaysia has an acid test ratio of 78, indicating they have only RM78 cents in highly liquid assets to cover 1 ringgit in current liabilities.
That's quite a disparity. Intan, what does this difference in ratio imply?
Well, an acid ratio above 1.0, as seen in GDAX 4.85, is a positive sign, indicating strong liquidity and the ability to meet short-term obligation without relying on inventory sales. On the other hand, Post Malaysia's ratio of 0.78 suggests they may face challenge in covering short-term liabilities with their available highly liquid asset.
Thank you for that explanation. So, Intan, what step can Post Malaysia take to improve their liquidity?
To improve liquidity, Post Malaysia could consider upgrading their asset management software. This upgrade would allow them to increase the lifespan of their asset and maximize their asset value. Efficient asset management can positively impact liquidity by ensuring that assets are utilized optimally.
Thank you both for your insights. So, in summary, Gdex appears to have a stronger liquidity position with a current ratio of 4.89, while Post Malaysia's ratio of 0.78 suggests they might need to focus on managing their liquidity more efficiently. Let's start by comparing their inventory turnover ratios, Danny.
Absolutely, Ashraf. The inventory turnover ratio for Post Malaysia Berhad is 4,034 ringgit 50 cents, whereas for Gdex Berhad, it's 25 ringgit 9 cents. This indicates that Post Malaysia Berhad is experiencing higher inventory turnover, showcasing stronger sales in comparison to Gdex Berhad.
Okay, Shira, what about average collection period?
Okay, moving on to the average collection period. Post Malaysia Berhad has a higher collection period of 137.49 days, indicating that it takes more time for them to collect their receivables. On the other hand, Gdex Berhad has a collection period of 56.49 days, implying a more efficient collection process.
Exactly, yes. This suggests that Gdex Berhad manages its collections more effectively as they spend fewer days in the collection period compared to Post Malaysia Berhad.
Yes, in summary, while Post Malaysia Berhad shows higher inventory turnover, Gdex Berhad excels in managing its collection period, resulting in a more efficient collection process.
Thank you for all your insights.
Let's keep working together to improve our financial strategies.
About debt ratio and time interest earn ratio for Gdex and Post Malaysia. Today, we're going to delve into the financial health of two prominent companies, Gdex and Post Malaysia. We'll focus on their debt ratio and time interest earn ratio. Are you ready to dive in?
Sure, Ashraf. I'm eager to learn more about how these ratios can provide insights into their financial situations.
Great, let's start with the debt ratio. This ratio indicates the proportion of a company asset that are financed by debt.
Got it. So, a higher debt ratio could mean the company relies more on borrowed funds.
GDET have a lower debt ratio. For GDET, debt ratio is 26%.
And what about Post Malaysia's debt ratio?
Post Malaysia debt ratio is 72%. This suggests that Post Malaysia has a higher reliance on borrowed funds compared to GDET.
So, a lower debt ratio like Gdex might be preferable for investors looking for a lower financial risk.
That's correct. A lower debt ratio generally signifies on a more conservative financial sector.
Okay, now let's move on to the time interest earn ratio. What does that measure?
The time interest earn ratio, also known as the interest coverage ratio, gauges as a company's ability to cover its interest expenses with its operating earnings.
A higher ratio would mean that a company is better positioned to cover its interest payment.
Precisely, GDEX time interest earn ratio is 5%.
And Post Malaysia's?
Post Malaysia's time interest earn ratio is 97%.
Okay, thank you for breaking down these concepts. It's been a productive session. Lastly, we'll be discussing the financial performance of Gdex and Post Malaysia, particularly focusing on their profit margins. Let's dive into it. Could you break down what that means?
Sure, Ashraf. As a per estimates provide, GDEC boasts a higher gross profit margin compared to Post Malaysia. Certainly, Ashraf, the gross profit margin is the percentage of profit company retains from the sale after deducting direct manufacturing expenses. In simple terms, GDEX is able to pocket a larger portion of the sale revenue as a profit.
Interesting. So Gdex is making more profit from its sales after considering manufacturing costs. Any ideas why?
There are a few possibilities. Ashraf, GDEX might have a more efficient cost structure or a smarter pricing strategy, which could be contributing to their higher profit margin.
But is gross profit margin the whole story?
You are spot on, Ashraf. While gross profit margin is crucial, it's a piece of the puzzle.
To truly assess their performance and overall health, we need to consider additional financial parameters, industry dynamics, their corporate plans, and the market conditions they operate within.
So, the gross profit margin is a starting point, and we need to consider the bigger picture.
Exactly, Iqbal. The holistic analysis provides a more accurate understanding of both companies. What about the net profit margin?
Great question, Ashraf. Uh, Post Malaysia is facing a deficit due to its negative net profit margin. On the flip side, Gdex in the black with a positive net profit margin, indicating they are making money. This statistic should be evaluated alongside other financial ratio, market condition, in the industry trends, and the company strategy to get complete understanding of their performance.
Thanks, Iqbal. The discussion really highlight the need for comprehensive approach assessing their financial health.
You are welcome, Ashraf. A well-rounded analysis lead to better decision.
Let's dive into the return on assets and return on equity of Post Malaysia and Gdex. These metrics are quite telling about companies' performance.
Yes, Ashraf. To start, Post Malaysia is experiencing a loss on its assets, indicated by negative return of asset.
Absolutely, Iqbal. To start, Post Malaysia is experiencing a loss on its asset, indicated by its negative return of asset. What about Gdex returns of asset?
GDET, in contrast, has a positive return of asset. This implies they are generating a return on their asset.
So Post Malaysia's negative return of assets means their assets aren't producing a positive return.
Exactly, Ashraf. A negative return of asset suggests their asset might not be efficiently contributing to their financial, possibly even causing losses.
And GDAX positive return of asset means they are making money from their assets.
Yes, Ashraf, the positive return of asset signifies that GDET is returning their asset into profit.
Now moving on to return on equity. Post Malaysia is facing a loss on equity as evidenced by its negative ROE. How does GDAX return of equity compare?
GDET's return of equity is positive but relatively low compared to the average profitable firm.
What does a low return of equity indicate?
A low return of equity means company equity capital is not generating much profit. It could be due losses or inefficiency. Even a low positive return of equity suggests they are making some profit from their equity.
Thanks, Iqbal. This discussion underscores the importance of looking at financial metrics holistically.
You are welcome, Ashraf. It's always pleasure to explore how this measure fit into the bigger financial puzzle.
Based on the analysis, participants should propose recommendation for each company whether the shares are worthy of investment.
Based on the analysis, I would like to recommend Post Malaysia Sdn Berhad as a company with a share worth of investment. This is because net profit margin of Post Malaysia higher than GDEC with 8.55% with only meanwhile the GDEC with only 4%. Furthermore, return of on asset of Post Malaysia have a positive return by 7.06%, while GDEX only 2.03%. Other than that, return on equity of Post Malaysia have a good return with 25.94%, more than GDEX with 23%.
That's all for our financial analysis mock meeting. Thank you everybody for contributing to this meeting.